Welcome everyone to my channel. My name is Parsh Mehra. In this video, I'm going to discuss more about initial public offering. The IPO market is also called the primary market. Sometimes attracts the companies offering their shares to the public without actually going through a healthy round of funding in the past. A few rounds of funding by credible venture capitals and equity capitals firms validate the quality of the business and its promoter. When a company decides to file for an IPO, the main reason behind is to raise funds to fuel their capex requirement. The promoter has three advantages by taking his company public. He is raising the funds to meet the capex requirement. He is avoiding the need to raise debt, which means he does not want to have any financial charges that can actually turn out his profitable in a low way. Whenever you buy a share of the company, you are essentially taking the same amount of the risk as the promoter is taking. The proportion of the risk and its impact will depend on the number of shares that a person holds. Nonetheless, whether you like it or not, when you buy the shares, you also buy the risk. So when the company goes public, the promoter is actually spreading the risk amongst the large group of people. There are other advantages as well. As when you talk about IPO, it provides an exit for the early investors. When the company goes public, the shares of the company starts trading publicly. An existing shareholder of the company could promote angel investors, venture capitals that can use this opportunity to sell their shares in the open market, reward employees. Employees working on the company for the company would have the shares allotted to them as an incentive. This sort of arrangement between the employee and the company is called the employee stock option. The shares are allotted at a discount to the employees. Improve visibility. Going public definitely increases the visibility of the company that has been status of publicly held and traded. There is a greater chance of the people interest in the company, consequently creating a positive impact on its growth. Having decided to go to the public, the company must do a series of the things to ensure the successful initial public offering. The first and the foremost step would be to appoint a merchant banker. Merchant bankers are also called book running leading managers or lead managers. The job of a merchant banker is to assist the company with the various aspects of the IPO process. They conduct due diligence of the company for filing an IPO. They ensure legal compliance are also fully up to date, and documents like red herring prospectus is being prepared. By underwriting the shares, the merchant bankers essentially agree to buy all or the part of the IPO shares and resell the same to the public. Then the company has to apply to the SEBI registered statement that contains the details of the company, what company does, why company plans to go to the public, and what is the financial health of the company. Once SEBI receives the registration form, SEBI takes a call whether to issue go ahead or not to an IPO. If the company gets the initial SEBI nod, then the company improves to prepare the DRHP. A DRHP is a document that gets circulated to the public along with a lot of information. DRHP contains the essentials of the companies. For example, the estimated size of an IPO, the estimated number of shares being offered to the public, complete financial statements, etc. Then the company does the marketing of the IPO that involves TV and printing of the advertisements in order to build awareness about the company and its IPO offering. This process is also called IPO roadshow. Then the day when the company actually gets listed on the stock exchange is known as the listing day. The listing price is a price decided based on the market demand and supply on that day, and the stock is listed at a premium, par or discount of the cut-off price. During the bidding process, the investors can bid for the shares at a particular price within the specified price band. The whole system around the date of the issue where one bids for the share is referred to as the primary market. Once the stock transactions from the primary market to secondary market, The stocks get traded daily on the stock exchange. People start buying and selling stocks regularly. Thank you so much everyone for watching this video. If you really like this video, please click on the like button, and also please subscribe to my channel. Thank you so much once again.